Hello, fellow Rebel Capitals. Hope you're well. So, I wanted to make sure that I did a video today on this topic. If you haven't heard, the regional banks are crashing once again. It's like March of 2023, deja vu. So, let's get right into this. Probably a quick video here. I just wanted to give you guys an update because I think this is really important stuff. I mean, I just did a whiteboard video that you should definitely check out on Jefferies and First Brands. And the whole theme of that video is where there's smoke, there's fire. In fact, Jamie Dimon just came out the other day and started talking about this. When you see one cockroach, rest assured, there's a lot more hiding. So when you look at First Brands, oh, that's a one-off, George. Quit fear-mongering. No, it usually isn't. It usually isn't. So let's get into exactly what's happening and then try to ask the question, where does this end? And is this the canary in the coal mine? And if you haven't watched that whiteboard video, you definitely should check it out because that gets into much greater detail than what we're going to go over just on this live stream. So I'm going to switch up the screen share. Josh, of course, is MIA. I don't know if he's on Tinder or might be on Grindr. Who knows? There are no certainties, only probabilities. I'll let you decide which is the highest probability. You let me know in the chat. Do you think he's on Grindr or do you think he's on Tinder? I don't know. Let's get right into enough of the important stuff. Let's just get to this petty regional bank crashing thing. All right. Oh, and that's not it. Here we go. Regional banks. Jefferies shares tank again. Remember, it was down 30% over the last, 3 or 4 weeks, something like that. So crashing once again, even further. But now it's taking the regional banks down as well because Zion Bank. Does that sound familiar? It should, because they had big problems back during 2023. And everyone says, oh, well, no, it's just a one-off. It's just Silicon Valley Bank. It was just First Republic. It was just Signature. Oh, and by the way, Credit Suisse as well. Yeah, I forgot about that one. All these other regional banks, they have a rock-solid fortress balance sheet. Maybe not. Maybe that BTFP thing was just kind of kicking the old can right on down the road. And they were able to paper over all of these problems. But now we're seeing a little more smoke come up. Let's get into the key talking points here. Regional banks stocks tumbled as fears mount around the health of their lending businesses. And, well, let's get into it here because you're going to be, on one hand, you're going to be shocked when you read about what's happening with Zion. And then on the other hand, you're going to be like, yeah, I mean, I'm surprised it took this long. Next key talking point. All but one stock in popular regional bank ETF is tracking to end Thursday down. Not just down. I mean, they're down big. So, okay. And we talked about how Jefferies down once again. Zion down 13%. Western Alliance down 10%. The regional bank ETF, KRE, down more than 6%. Looks like they're down even further in after hours. That would be Zion. So here you go. What is going on? This is the dealio. The bankruptcies of 2 auto industry related companies this year raised concerns about loose lending practices. Yes, of course. And if you watch that whiteboard video, it was all about the tide. I was using that as an analogy. Hat tip, Warren Buffett. When the tide is in and the tide is high, then everyone's partying like it's 1999. Especially with the AI bubble, right? No pun intended. But when everyone's partying like it's 1999 and stocks are going up and then lending standards loosen, and then they loosen to the point where there's just outright fraud. And because people are incentivized to, get rich quick, let's go out the risk curve because everybody's doing it. Hey, sure, it's a game of musical chairs, but the music's still playing, baby. And if the music's still playing, you got to dance. No one's taken away the punch bowl yet. But what happens is sooner or later, that tide, which is the economy, starts to go out and boom. Oh my gosh, First Brands, they were swimming naked. But the problem is First Brands, their balance sheet is connected to a lot of other balance sheets that might still be neck deep in water, but they're just as bad. So it's just a matter of time. And then you start to see all the cockroaches start to scurry when the tide goes out further and further and further. That's why I said in the video, this First Brands thing, that could have been the canary in the coal mine. And it seems like the probabilities are increasing. We're not there yet, but probabilities increasing that that's exactly what was going on here. And you're likely going to see more and more and more. And that's exactly, by the way, what Jamie Dimon just said. Okay, so latest signs of trouble came when Zion's said Wednesday evening it faced a sizable charge because of bad loans to a couple of borrowers, despite expecting this was isolated instance. They always say that. It's always an isolated instance. Always. I mean, what are they going to say? Yep, we're screwed. Of course not. Remember Lehman? I mean, they were saying Lehman was fantastic all the way up until, I think it was a Friday, wasn't it? And then on Monday, it's like, oh, sorry, we're insolvent, closing the doors, filing for bankruptcy. In fact, even First Brands. Remember, Jefferies was going to do a cash out refi for $6 billion. So that means the valuation of First Brands, like a month ago, was got to be north of $6 billion, probably right around $10 billion. A month ago, you got a company that's worth $10 billion. Today, they're worth goose egg. In fact, they're worth negative goose egg. They're worth negative dollars. Totally insolvent. They can't even pay back their creditors. In fact, they lost $2 billion. And it's not that they ever had it. They just don't know where it went. They don't know if they even had it to begin with. I mean, this is the financial shenanigans that you see when the tide is in. And it makes sense. It's the way these boom bust cycles work, because when the tide is in, there's cover. No one's going bust. So we might as well take more risk and more risk and more risk and more risk until you get caught with your pants down. It's exactly what's happening here. Western Alliance then alleged Thursday a borrower had committed fraud. Like, this is exactly what I'm talking about. So Zion comes out and says, oh, yeah, by the way, we're going to take a couple sizable charge offs, or whatever they call them, for bad loans, but don't worry about it. Just a couple borrowers, isolated instance. Oh, look, a squirrel, right? And then Western Alliance, one of their competitors, comes out and says, yeah, I guess since we're all about telling the truth now, I mean, Zion, they went first, so all right, fine. It's true. We had a borrower that actually committed fraud, but it's an isolated instance. This rattled investors, as you would expect. Here's a quote. While we are questioning why all of these credit one-offs are seemingly occurring in a short period of time, I can tell you why. Because that's how these cycles work. That it's the fact that people are questioning this is mind-boggling. Like, you could have seen this coming from a mile away. And oh, by the way, what has the yield curve been telling us? Right? Has the yield curve been inverted for a long period of time before we had a recession? Yes, absolutely. But the yield curve doesn't necessarily mean, hey, there's a recession. It just means that, hey, there's a lot of risk in the system. And you can tell because those banks that are the marginal buyer or seller, they're out there buying along into the curve because they have an option. They have two options with the balance sheet capacity. Either you lend into the real economy and take a higher interest rate, or you go safe and liquid. And then you're going to take that 10-year treasury or whatever it is, and that's going to bring down the rate. It's going to invert the curve. That's what happens. And usually that happens as the Fed is increasing rates at the front end. And so there's a reason. It's not just, oh, the curve's inverted. I wonder why. Well, must not mean anything. Anyway, boy, how are those regional banks doing? Let's load up on some of those shares. Those things are going to the moon. The yield curve was interest rates, is what I'm really trying to say. It was telling you everything you needed to know. Oh, and here they're talking about cockroaches. I didn't even know they did that. Looking for cockroaches. The worries about the health of the banking system or banking industry originated with bankruptcies from First Brands, Tricolors, auto part maker First Brands. Okay, we know what happened there. Shares of Jeffrey which has exposure to First Brands, fell 10% just on Thursday. The investment bank stock has lost more than 25% in October, making it poised to record its worst month since the Cerveza sickness. Jefferies said hedge funds it runs are owed 715 million from companies tied to First Brands alone. And look, you've got to ask, okay, it's 750 million to First Brands, but that was just one loan you made. If you're making these terrible, toxic loans, what else is on your balance sheet that we haven't seen yet, but we will likely see in the very near future? And here's Dimon. Here's the quote. He said, "When you see one cockroach, there are probably more." CEO Jamie Dimon said on the company's conference call earlier this week in relation to First Brands. Yeah, and at the time, he probably didn't even know, but he, I'm sure, assumed that the regional banks were going to have a lot of problems. And I think this is just the first of, unfortunately, many situations and many stories like this. And I've usually what happens is these things get a lot worse before they get better. Now, the question is, what does the Fed do? Is the Fed going to step in with a BTFP, something like that? And by the way, can they even, I don't even know if that would be applicable to Jefferies, obviously the regional banks, but something like Jefferies, they're a non-depository lender. So how does the Fed navigate that? Another special purpose vehicle? Who knows? We'll have to wait and find out. An opaque market. Mayo said credit quality in overall industry is still considered favorable. Yeah. Just give it a couple days. However, he said recent developments show low margin for error when there's hiccups. And low margin for error? What are you talking about? They're just lending to anyone that has a pulse. I don't think that's low margin for error. I think that's just making stupid decisions that are going to come back and bite you in the ass. Again, that's what happens when the tide's in, or the tide is high. They said this private credit market is opaque. Yes, that's the whole thing banks are doing, because the banks, they can't lend to a First Brands. In my whiteboard video, I called it Garbage Corporation with a triple F rating. They can't lend to that company. So what they do is they just lend to Jefferies, and then Jefferies lends to Garbage Corporation, as if that's any better. So then they go over all these share prices that tanked. It's like, here you go. Apollo, Carlyle, Blackstone, they all fell 6%, 3%, 5%, 4%. So they can't access the BTFP if the Fed sets that up again. So I'm not saying the Fed isn't going to bail them out. I'm sure they will if it comes to that. But I don't know if they're really going to have to pull something out of the hat that is completely against the Federal Reserve Act. I mean, but people just ignored the Federal Reserve Act back in the Cerveza sickness. So why won't they do it again? So that's what's going on, guys. Wanted to give you just an update there, because this is something extremely important, very, very important. And if you want more kind of details as to what's going on with private credit and the whole shadow banking system, because that's what we're talking about here, I would strongly suggest checking out that whiteboard video that I did last night on the George Gammon channel. And for those of you who are wondering, what on earth do I do with my portfolio? I mean, we're in all of these financial bubbles, whether it's the AI bubble, the private credit bubble, the housing bubble, the this bubble, the that bubble. There's all these financial bubbles. What the heck do I do? Well, I've got good news for you. I'm doing a webinar October 29th, and I'm going to walk you through the contrarian strategies the pros use to really invest during these times of financial bubbles. And, spoiler alert, it isn't doing the whole buy and hold thing. It isn't buying the dip. It isn't just taking 10% of your paycheck and investing it into a passive S&P index fund. That is the opposite of what you want to do. So I'll be going over all of that and taking you through step by step. So whether you're a noob or someone who's experienced, this is absolutely perfect for you. It's free to register. Josh will put a link right there, put a link in the description. And the huge bonus here, just for attending, you are going to get a coupon code for Rebel Capitalist Live 2026. How awesome is that? $500 coupon code that takes the price of a ticket for Rebel Capitals Live 2026 all the way down to $99. You can't beat it. This webinar is going to be absolutely incredible. So check out the link, register for free, and I will see you October 29th. On that bombshell, enjoy the rest of your evening. As always, make sure you're standing up for freedom, liberty, free market capitalism, where we actually let entities go bust that make bad decisions. I'll see you in the next video.